Hi class, this is Mr. Tan again, and we are in hospitality and finance, and today we are focusing on question 4.1. So in 4.1 we're actually looking at various ratios, and in the case assignment it says you've been approached by two restaurant owners who are willing to sell. One of them is Mr. Abraham, the owner of a Thai restaurant, who has presented an extract from his financial statement, and the other is Mr. Hussain, the owner of another restaurant, and has produced his ratio analysis for AC 4.1 and 4.2. Okay, so we need to provide various ratios to make comparisons between the two companies. So the first ratio we're going to do is the gross profit percentage margin. What is the gross profit percentage margin, please?
I will share after the data.
It's a gross profit divided by sales multiplied by 100.
Good. So the way to work it out is your gross profit divided by sales multiplied by 100. So you must put the formula in first. And then when you're taking the figures out of the case study, then you put the figures in next. So what figures do we have for here? What's the total sales of the restaurant?
369.
Total sales at 837. Divided by, so your gross profit is how much? 359. And you divide it by your total sales of 837 times by 100, which gives you how much?
43.
Approximately 43%. So what is the gross profit percentage margin measuring then? So how would you explain this? So really, this is a financial metric used to assess the company's financial position. And it takes away the money left over after you've deducted the amount of cost of goods sold. So you have your sales minus your cost of goods sold gives you your gross profit. And then to work out the gross profit percentage margin, you take your gross profit divided by your total sales times by 100 gives you your gross profit percentage margin. Okay? So the next one is the operating profit margin or the net profit percentage margin. So what is, before you tell me the formula, what is the net profit percentage margin?
So is the amount of money that you get
Yes.
after you take any your expenses from the gross profit?
Yes. So good. So the operating margin measures how much profit a company makes on every pound of sales after you've deducted the variable costs of production and the administration costs in terms of wages and raw materials and so on and so forth, but before paying any interest or tax to the government. So your net profit is worked out by taking away your administration costs from your gross profit, which gives you your operating profit or your net profit. And how do we work out the net profit percentage margin?
Net profit divided by sales.
Good.
Times 100.
Good. So you work it out. The formula is your net profit divided by total sales times by 100. So in this case, how much was the net profit?
135.
135 million. Okay, but let's see 135. And how much were your total sales?
837.
837. Good. And if you divide 135 by 837 times 100 gives you how much? Approximately 16%. You can round these figures up. Okay. So your net profit percentage margin then in this example was 16%. Okay. The next one we had to measure and to work out was the current ratio. What is the current ratio saying? Before you give me the formula and the figures, what is the current ratio saying?
So it says whether the company is able to pay its debt
Short-term
Yes.
within
Yes.
12 months.
Yes, because we're looking at the current assets and current liabilities. So we're talking about payment within 1 year, so the short-term liabilities. So we're saying that the current ratio is a liquidity ratio that measures the company's ability to pay the short-term obligations within 1 year. To pay its obligations in 1 year. And what's the formula for this, please?
current assets divided current liabilities.
Good. So the formula for this is the current assets total current assets divided by total current liabilities. And in this instance, what are the total current assets, please? 176 divided by 90 gives you how much? 1.95. So this tells us what? 1.95 tells us what? Someone wants to summarize this?
Times you can cover your liabilities.
Yes, it can cover it 1.95 times. Cover your current liabilities in 1 year. Good.
So it's nearly 2 times.
Almost 2 times, but not quite. Okay, the quick ratio. The quick ratio is slightly different. It's similar. You take your current assets minus your stock or inventory divided by your current liabilities. Okay, so what is the quick ratio saying? Tell me what it's saying. Well, what? Yeah, go on.
So it tells us the number of times that we can cover our debt after
Yes.
you've taken our stock or the inventories from current
Yes.
assets.
Yes. So correct. You're saying, taking away the stock, because the stock may take longer to sell. You know, what are our most liquid assets? The current assets. And this is saying that the quick ratio indicates the company's short-term liability and measures the company's ability to meet its short-term obligations with the most liquid assets. The most liquid assets. Yeah? So that doesn't include the stock or inventory, because the stock and inventory may take time to sell. And so the formula for this is current assets minus stock or inventory divided by current liabilities. So what figures do we have for this? What's the current assets?
176.
176 minus
43.
divided by
90.
gives you
1.4.
1.47?
1.47 approximately, yeah? So this is telling us what? What is 1.47 telling us?
This could cover all your liabilities. This
How many times?
1.47 times.
1.47 times, good. Yeah? Which is not a bad position to be in, is it? You don't want it to be too high, because if you've got so much assets and liquidity, then you might say, well, hang on a minute, are we utilising our resources as effectively as we can? Okay? Okay. So the next one we want to do is the trade receivable period. Who would like to explain what is the trade receivable period?
That's deliverable to somebody.
Yes, so we are delivering our goods to someone, and then they haven't paid us yet. So what is it then? It's
Period when you're expecting money.
Yes.
back.
it is the period when we're expecting. Once we've invoiced that customer, how long is that going to take for us to get that payment back into our bank in terms of cash? Okay, so the trade receivable are amounts billed by a business to its customers when it delivers goods and services to them in the ordinary course of business. These billings are typically documented on the formal invoices, which are summarized in the accounts receivable report. And then again, these invoices are sent out, and how many days does it take? What's the formula for this, please?
Is account receivable divided annual sale divided 365.
Good, thank you. So you have your accounts receivable at the top, and then you divide that by your annual sales divided by 365. What do we work out first?
Annual sales.
Yes.
Annual sales
divided by 365. So in this case here, what are the annual sales?
836.
Good. Divided by 365 gives you what?
2.29.
Good. And what's the total amount for the accounts receivable?
96.
Good. 96 divided by 2.29 gives you how what?
41.9.
41.9 what?
Days.
Days. Good. So this is telling you that on average it's taken you, once you've invoiced your customer, 41.2 days for you to get your money back in. Yeah? Now we're moving on to trade payable. What is trade payable, please?
Invoices that you have to pay to your creditors.
Good. Invoices that you're going to have to pay to your creditors. So you now get invoiced for things that you bought but you haven't actually paid for. And this is saying how many days is it actually taking for you, once you've received that invoice, to pay that out of your account. So the trade payable is an amount billed to a company by its suppliers of goods and delivered to or services consumed by the company in the ordinary course of business. These billed accounts, if paid on credit, are entered onto your